Welcome back to Biz Intel, your weekly briefing on the subtle shifts reshaping the global economy. This week began with a story no one saw coming. The CEO of one of the world's leading AI firms sent an internal 1,600-word memo. In it, he labeled competitors as frauds and described their employees as gullible. He also dismissed rival safety commitments as mere performance art. The memo leaked to the public within days. It triggered a response from the U.S. Department of Defense. It sparked an unprecedented collective petition within the industry. And it ignited a public debate over the question Silicon Valley has been avoiding: who does AI actually serve? That is our lead story. But it is not the only story this week. Hundreds of billions of dollars are flowing into AI infrastructure through bonds, private equity, and chip leasing deals, even as hidden financial risks surface. Traditional enterprise software stocks continue to slide while CEOs struggle to answer anxious shareholders. China has quietly secured key chip deals and is preparing to launch AI agents to 1.4 billion WeChat users. And in the shadows, tech billionaires are pouring capital into a different race, a quest to defy the laws of nature. AI defense and Silicon Valley's new war. Anthropic vs. OpenAI, from the boardroom to the Pentagon. The biggest story of the week began with a high-stakes leaked internal document. Anthropic CEO Dario Amodei sent a 1,600-word memo to employees in which he used the word fraud to describe his competitors and labeled the OpenAI team as a gullible bunch. The core issue was that Anthropic had been flagged as a supply chain risk by the U.S. Department of Defense for refusing to allow the military to use its AI for sensitive privacy and high-level military applications. Although the content was intended only for internal communication, the leak nearly derailed ongoing negotiations between Anthropic and the Pentagon. The fallout was immediate. Joshua Kushner of Thrive Capital responded publicly on X, stating that Dario's commitment to hating OpenAI appeared stronger than his commitment to Anthropic's own values. Secretary of Defense Pete Hegseth threatened to invoke the Defense Production Act to force compliance, while one senior official reportedly accused Amodei of having a God complex. Amodei later issued a public apology, but a notable detail emerged shortly after the controversy. The Claude app surged to #1 on the free App Store, overtaking ChatGPT, precisely as Sam Altman was signing a deal with the Pentagon. Whether by coincidence or not, the market seemed to vote with its downloads. On OpenAI's side, the company initially agreed to let the Pentagon use its AI for any lawful purpose, a phrase broad enough to cover a wide range of activities. This led a wave of employees to immediately remove ChatGPT from their personal devices. Altman was forced to renegotiate, adding a clause that prohibits the use of AI for civilian surveillance via commercial data. Interestingly, over 100 OpenAI employees and 600 Google employees signed a petition supporting Anthropic's stance, marking the first time industry professionals have publicly expressed solidarity with a direct competitor. Professor Margaret O'Mara from the University of Washington summarized the situation perfectly. The stakes are higher, the personalities are bigger, and everything is being scaled up. However, looking past the headlines, a very pragmatic race is still unfolding beneath the surface. Who grows faster? Who burns more cash? And who has the chance to go public first? Anthropic currently generates an estimated $20 billion in annual revenue, nearly doubling in less than 6 months. Its gross margin, the revenue left after direct operating costs, reached 40%. An impressive improvement from last year's negative 94%, though still 10 percentage points below their own target. OpenAI has surpassed $25 billion in annual revenue with over 920 million weekly active users, but its operating costs have quadrupled to $8.40 billion, nearly half of which serves free users. Their actual gross margin is 33%, falling short of their 46% goal, with plans to bridge the gap through advertising and e-commerce. Regarding an IPO, NVIDIA CEO Jensen Huang predicts that OpenAI will list by the end of this year. However, with a valuation of $850 billion, meaning investors are paying the equivalent of 28 years of current revenue, many large funds are showing caution. Analyst Jim Chanos posed a blunt question. NVIDIA has a monopoly, strong growth, and massive margins. Why would you pay a higher premium for OpenAI? Behind this politically charged confrontation lies a much more practical question. What are these AI companies actually building? A new layer of assistance running on top of old software, or a platform powerful enough to replace the entire enterprise software industry from the ground up? The AI race. Who is AI really trying to replace? Enterprise software, the human resources, accounting, sales, and operations tools that companies purchase via annual subscriptions, is one of the largest and most stable markets in the tech industry. And this is exactly where AI is setting its sights. Anthropic launched Claude Cowork, connecting with DocuSign, LegalZoom, and Salesforce. Its positioning is clear. Cowork replaces the worker, not the software. Employees continue to use their legacy applications, while the AI simply performs the tasks for them. OpenAI, meanwhile, has been blunt with investors, stating that future products will replace the likes of Salesforce, Workday, Adobe, and Atlassian entirely. This is not about integration, but rather total replacement. One cybersecurity executive revealed they have already used an AI agent to replace a CrowdStrike tool worth $100,000 per year. It is a small anecdote, but it perfectly illustrates the existential dread currently reflected in enterprise software stocks. However, OpenAI's ambitions do not stop at rewriting enterprise software. The company is simultaneously expanding its consumer strategy, a space where AI doesn't just work for humans, but talks, creates video, and drives commerce. ChatGPT's current voice feature operates on a turn-based system, where the AI must wait for the user to finish speaking before responding, much like an old-generation satellite phone. OpenAI is developing a new model capable of listening and adjusting responses in near real time. This beta version still has bugs and is expected to launch in the second quarter or later. Additionally, OpenAI is preparing to integrate Sora, its video generation tool, directly into ChatGPT rather than maintaining a standalone app that currently ranks poorly on the App Store. The goal is to recreate the viral momentum of the Studio Ghibli-style photo craze from last March. The inherent risk is a potential spike in operating costs if the trend takes off, something OpenAI is keen to control after the lessons learned last year. Notably, OpenAI has moved away from direct payment models within ChatGPT after conversion rates fell below 1%, far lower than the e-commerce industry average. The new direction involves Shopify, Etsy, and Instacart building dedicated storefronts within ChatGPT to offer a more controlled shopping experience. If these total replacement claims sound bold, the stock market has already begun reacting as if they are true. That reaction is leaving enterprise software CEOs to face difficult questions from shareholders every quarter. Salesforce, Snowflake, Palantir and many other giants have lost 20 to 30% of their value since the beginning of the year. Atlassian has fared even worse, dropping over 65% in 12 months and recently cutting 10% of its workforce. CEO Mike Cannon-Brookes stated flatly that while AI may not replace humans, it would be dishonest to pretend it is not changing the required skill ratios. The situation at Workday is similarly grim. Slowing growth caused the stock to drop another 8% in after-hours trading. CEO Anil Bousri, who recently returned to lead after the stock plummeted 39% year-to-date, maintains that AI will not replace HR and ERP software. The market has heard the message, but it remains unconvinced. Figma CEO Dylan Field perhaps offered the most honest take about trusting AI with critical tasks without oversight. He said that if you are willing to turn over a critical task to an AI agent without oversight, you are very brave. While many software companies are on the defensive, Microsoft is taking a completely different path. Most AI firms are shifting toward usage-based pricing, but Microsoft launched its E7 plan in May with a flat fee of $99 per user per month. The plan integrates the full Office 365 suite with Copilot. Satya Nadella is betting that in-house cloud infrastructure will protect profit margins. On the other hand, Microsoft is facing simultaneous antitrust investigations in the US, Australia, the EU, and the UK regarding the bundling of Office, Windows, and Copilot. To understand why this race is so intense, one must look at the deeper layer. If AI is to truly change how software is built and used, it requires a massive foundation of computing infrastructure. The race to build that infrastructure is consuming figures unprecedented in the history of technology. Oracle and OpenAI did not expand their data center in Abilene, Texas as planned, but not because the project failed. OpenAI wants to use next-generation chips at a private location while Abilene lives on thanks to a $150 million deposit from NVIDIA to the landowner. Microsoft and Meta are both in talks to lease space there. Oracle still reported a strong quarter with its stock up 9%, and it plans to spend $50 billion in capital expenditures for fiscal year 2026, double the previous year. From here, the story is no longer just about who builds the data centers, but who has the balance sheet to fund them. Amazon recently issued nearly $40 billion in bonds, both domestically and internationally, to fund its AI investment wave. Amazon's capital spending this year has increased by 50% to approximately $200 billion. Salesforce is taking a different route, raising $25 billion in bonds to buy back shares and shrink its outstanding stock by about 13%. Moody's reacted by downgrading Salesforce's credit rating from A1 to A2, citing a significant shift in financial policy. As this massive capital flows into AI infrastructure through various channels, financial risks are beginning to surface in overlooked places. This is a quiet but critical story to watch. Blue Owl Capital, a private equity firm managing $300 billion, is facing trouble with its stock down 30% in 2 months. A $1.6 billion fund under its management failed to meet investor redemption requests. Last year, Blue Owl poured billions into data center projects. Analyst Greg Obenshain summarized it best, saying problems do not appear when the money is coming in, they appear when the money starts to leave. Capital is only half the equation. The other half is hardware. Who will provide enough chips to power this AI wave without locking the entire industry into NVIDIA? OpenAI signed a $10 billion contract for chips from Cerebras Systems as a concrete step toward reducing dependence on NVIDIA. Cerebrus designs chips optimized for the inference stage, which are faster and less resource-intensive than standard GPUs. OpenAI is also co-developing a custom processor with Broadcom. Google's TPU chips, designed specifically for AI, are also gaining ground as an alternative to GPUs. Anthropic plans to triple its TPU usage by 2027, and Meta recently signed a multi-billion-dollar deal to lease TPUs from Google Cloud. A hot topic this week is the impact of geopolitical instability in the Gulf. The UAE and Saudi Arabia plan to spend over $300 billion on AI. But regional instability is complicating the picture, including an infrastructure disruption that affected several Amazon data centers in the area. According to IDC analyst Stephen Minton, if the instability lasts for several months, there could be a pause in investment. However, focusing only on U.S. companies misses half the picture. While Silicon Valley debates safety, costs, and valuations, China is following a different path. China is building every layer of a domestic AI ecosystem, from chips to end-user applications. Samsung and SK Hynix are prioritizing high-bandwidth memory for U.S. big tech, creating a potential gap. That gap opens room for two Chinese names, YMTC and CXMT. Alibaba, ByteDance, and Tencent have reached preliminary agreements with both domestic manufacturers. Chips are only one layer in the AI stack. At the application level, Chinese firms are also accelerating in their own unique way. Tencent is quietly building an AI assistant connected to millions of mini programs within WeChat. This assistant will allow users to book taxis, shop, or order food through simple conversation. Notably, the WeChat team is not using Tencent's internal Hunyuan model, finding it not yet powerful enough. They are currently testing DeepSeek, Alibaba's QN, and Zhipu side by side. The launch is planned for the third quarter of 2026. While Tencent builds for the WeChat ecosystem, Alibaba is testing AI directly within e-commerce. Alibaba already reported concrete results during a recent Lunar New Year campaign. Alibaba's QN app processed nearly 200 million orders during the campaign. Daily active users jumped from 17 million to 73.5 million, a dramatic increase. This surge far exceeds any reported figures for AI commerce apps from Amazon or OpenAI. The remaining challenge is that integration with Taobao is not yet complete. Currently, the AI provides buying guides rather than leading directly to products. In another development, General Atlantic is selling a portion of its ByteDance stake at a $550 billion valuation, a massive jump from $330 billion last year, and more than 27 times the $20 billion valuation at the time of their 2017 investment. Like any major tech race, this competition isn't just between giants. It is also driving a wave of venture capital money from funds betting on startups they believe will shape the future. The AI-powered coding assistant Cursor is in talks for a new funding round at a $50 billion valuation. Its annual recurring revenue hit $2 billion in February 2026, up from $150 million just a year ago, a 13-fold increase in 12 months. Spark Capital, an early investor in Anthropic, is raising about $3 billion for a new fund, a 50% increase over its predecessor. Its $450 million investment in Anthropic in 2023 has now increased nearly 100 times. Khosla Ventures, an early backer of OpenAI, is also raising over $4 billion. However, the industry-wide picture isn't entirely rosy. Total global venture capital fell 34% to $68 billion last year. Capital is concentrating more narrowly into fewer companies at higher valuations. In the defense sector, Anduril, which builds autonomous weapons and surveillance systems using AI software as its core, raised $4 billion from Andreessen Horowitz and Thrive Capital, reaching a $60 billion valuation. Revenue is expected to nearly double to $4.3 billion this year, as the company builds a $900 million factory in Ohio while awaiting a decision on an autonomous fighter jet contract from the U.S. Air Force. Together AI, a cloud platform for leasing AI processing power, is in talks to raise $1 billion at a $7.5 billion valuation. Its annual revenue has reached $1 billion, tripling since mid-2025, with Saudi Arabia's Aramco Ventures discussing a major investment. In an entirely different market, the online fashion brand Quince is raising at a valuation of over $10 billion, double its previous round. The model is simple. Factory direct sales promoted through influencers and word of mouth, a clear sign of recovery for direct-to-consumer brand investments, a sector that had been largely frozen since 2022. When money flows this heavily, its impact often ripples far beyond the core of technology. This past week has shown that in the most unexpected places. The tech race, from cells to infrastructure. Technology is no longer just a peripheral support tool. It is deeply penetrating the very cells of our existence, directly redefining health, extending the limits of longevity, and establishing entirely new standards for modern living. Matrix Bio, a startup with only $4 million in capital, is performing mitochondrial transplants, organelles responsible for energy production in cells that are believed to decline with age, from young donors to the elderly at $50,000 per session. These procedures are part of clinical trials not yet officially approved by U.S. drug regulators, and the long-term safety and efficacy of this method have not been confirmed by any medical body. They are not alone in this pursuit, as tech giants pour personal fortunes into the race against time. Sam Altman has personally invested $180 million into Retro Biosciences, a startup with the bold goal of extending human life by 10 years by preventing age-related diseases at the cellular level. Meanwhile, Jeff Bezos is making an even larger bet with a $3 billion investment in Altos Labs. This project brings together world-leading scientists to find ways to reprogram aging cells, helping them return to a youthful and healthy state. Remarking on this sense of urgency, Matrix CEO Tom Benson noted with subtle irony, "Perhaps Sam Altman isn't in a hurry. After all, he's only 40. On the other hand, the biohacking community in Silicon Valley is bringing longevity home with personal saunas. Numerous studies link regular sauna use to a reduced risk of cardiovascular death and improved longevity. Options range from $699 sauna bags to luxury $72,000 wooden cabins, a small but rapidly growing market. However, optimizing lifespan doesn't stop at physical habits like home saunas. It delves into the core of every individual, the genetic code. 23andMe was once the world's most famous consumer DNA testing company, where users sent saliva samples to learn about their ancestry and genetic disease risks. After the company's bankruptcy, Co-founder Ann Wojcicki spent over $300 million of her own money to acquire it and convert it into a non-profit organization. The goal is to maintain the genetic database of 13 million customers, making it available to global researchers while aiming to raise $100 million in philanthropic funding. While biological data aims to salvage the human future, hardware giants are reshaping the future of green transportation. BYD launched a new version of its Blade battery that can reach a full charge in 9 minutes across 10 new vehicle models. However, BYD's sales fell 36% in the first 2 months of 2026. Geely has overtaken BYD to become China's largest automaker. At the same time, 2 next-generation battery startups have either closed down or halted development. Yet battery performance is only one piece of the puzzle. The true shift may be that we no longer need to drive at all. Zoox, the Amazon-owned autonomous vehicle company, builds steering wheel-less robo-taxis powered entirely by AI. Zoox has partnered with an external ride-hailing firm for the first time. Their vehicles will appear on Uber in Las Vegas this summer and in Los Angeles next year. Waymo remains the leader, operating commercially in 10 U.S. cities and collaborating with Uber. Beyond longevity genetics and autonomous vehicles, the past week saw other notable developments. The battle for Warner Bros. Discovery continues with a bid backed by Larry Ellison worth over $108 billion. That bid competes directly with a $72 billion offer from Netflix. Netflix has only a few days left to decide whether to raise its offer. A California federal judge dismissed xAI's lawsuit accusing OpenAI of stealing trade secrets due to lack of evidence. xAI has until March 17th to file an amended complaint. After years of downplaying its Chinese roots, Shein founder Xu Yangtian appeared at a Guangdong government forum pledging $1.5 billion in investment over 3 years. This move signals a clear strategic reversal for Shein. Looking at capital flows, AMD and Meta signed a multi-year agreement to deploy large-scale AI processing infrastructure. Anthropic opened a share sale at a $380 billion valuation, totaling $6 billion in value. Cerberus filed for an IPO for the second time, with plans to list as early as April. IBM shares fell 13% after Anthropic announced that Claude Code could automate upgrading legacy software systems. Canva continued its expansion with 2 new acquisitions. Individually, these stories may seem disconnected, but placed side by side, several major trends become clearer. Conclusion: beyond the billion-dollar figures. 4 major themes emerge this week. First, the line between AI and state policy is blurring. For the first time in Silicon Valley's history, an AI company has been labeled a supply chain risk by the U.S. government. The question of what should AI be used for has moved beyond internal boardrooms to become a primary concern for regulatory agencies. Second, enterprise software is at a critical turning point. Analyst David Reederman describes this as a vortex of innovation from 2 private companies disrupting the entire public stock market. The question is no longer whether AI will have an impact, but rather who controls the data gateways and who sets the price. Third, the infrastructure race is giving birth to systemic financial risks. Hundreds of billions of dollars are being raised through bonds, private equity, and investment funds. But as the Blue Owl story demonstrates, these complex financial structures can face significant issues when cash flows reverse. Entry is easy. The exit is where the real concern lies. Fourth, China is not being left behind. From domestic memory chips to AI assistants within WeChat, China is innovating across hardware and software. Alibaba's QN processed 200 million orders, while ByteDance is valued at $550 billion, showing rapid scale and investment. However, one detail from this week warrants deeper reflection. Over 600 Google employees signed a petition supporting Anthropic. This wasn't motivated by money or pressure, but by the belief that Anthropic was right. This is an unprecedented event in the tech industry. It raises a question far more interesting than any valuation figure. Where will the loyalty of industry professionals lie? With the employer who pays their salary, or with the value system they believe in? This week ends with more questions than answers, and perhaps that is a good sign. One big question remains open. OpenAI is preparing to go public at an $850 billion valuation, while profit margins fall short and operating costs rise. Is this a good time to list, or are they racing against a countdown clock few can see? BizIntel will continue to monitor these developments and the new stories that are sure to emerge. Thank you for joining us. See you next week.